Good morning. My name is Alyssa, and I will be the conference operator today. At this time, we'd like to welcome everyone to the Michaels Company's first quarter 2020 earnings conference call. All lines have been placed on mute to prevent any background noise. If you need assistance during the conference call, please press star, then 0, and an operator will assist you. Please note this event is being recorded. Thank you, and now I'd like to turn the conference over to your host, Jim Mathias, Director of Investor Relations. Mr. Mathias, you may begin your conference.
I'd like to welcome you to our fiscal 2020 first quarter financial results conference call. Presenting on this morning's call is our CEO, Ashley Buchanan. Also on the call and available for the Q&A portion is Jennifer Robinson, our SVP Finance, and Jim Sullivan, our SVP and Chief Accounting Officer. Note, for today's call, the supplemental slide deck available on our investor relations website contains additional financial content to support today's discussion. Before we begin our discussion, let me remind you that the comments made on this call, as well as supplemental information provided on our website, may constitute forward-looking statements and are made pursuant to and within the meaning of the Safe Harbor provisions of the Private Securities Litigation Reform Act of 1995 as amended. These forward-looking statements involve risks and uncertainties that could cause actual results to differ materially from those anticipated by these statements. Information about these risks is noted in our earnings press release and the risk factors in our latest annual report on Form 10-K filed with the SEC, as well as in our other SEC filings. These forward-looking statements are only as of today, June 4th, 2020, and the company assumes no obligation to update these statements except as required by law. Investors are cautioned not to place undue reliance on these forward-looking statements. Also, please note that we will reference non-GAAP financial measures on today's call. A reconciliation of these measures to the corresponding GAAP measures are detailed in today's earnings release, as well as the supplemental slides. I'd now like to turn the call over to our CEO, Ashley.
Thank you for joining us today. I would like to begin by saying that our thoughts are with those who have been impacted by the COVID-19 pandemic. To those on the front line and all the essential workers, including our own store associates, who have been dedicated to serving our communities, from all of us at Michaels, thank you. We believe that Michaels is an important part of the many communities we operate in across the country. And we're doing our part to help during this difficult time. We made a significant donation of fabric used to make face masks and provided instructions on mask making on our website. We also collaborated with organizations to provide face masks to our frontline workers. Separately, we are pleased that we've been able to continue to support our maker community, providing resources and offerings that bring a sense of comfort and distraction from the stress and uncertainty created from the COVID-19 crisis. Our customers are telling us that crafting is an essential coping mechanism, sometimes ahead of exercise, reading books, or even being outside. Our research has found that 3 out of every 4 makers are crafting more during this time. And with a desire to learn and experiment, makers are starting new hobbies too. And as we have listened to our customers, we have found our makers are using arts and crafts for a number of reasons, including a way to make a difference, a way to make plans for their children, for some, a way to make money. Many of the initiatives I've discussed on today's call focus on improving our ability to enable our makers to purchase the craft supplies that are really needed during this period. I am very proud of how our entire team pulled together to help our communities and customers meet the challenges presented by COVID-19. Before I get into details for the quarter, I want to highlight 3 key areas we've been focused on as we navigate through this environment. First, the safety and well-being of our employees and customers has been and remains our top priority. During the quarter, we developed and implemented health and safety protocols across our store base that included limiting store hours, increasing cleaning and sanitation, as well as social distancing measures. Additionally, we provided thermometers for associates, installed plexiglass shields at checkout, and hand sanitizer dispensers throughout our stores to protect both our customers and our associates. Second, we focused on our financial health. So very early on, we took a proactive cost and cash management actions to provide ourselves with sufficient liquidity to comfortably weather the crisis. And as the economy begins to reopen, we are well positioned to continue leaning forward and emerge as a stronger company. And third, our team did a great job aggressively expanding our digital and omni-channel capabilities this quarter. We rolled out capabilities to give our customers the ability to shop how and where they want, while also reducing friction around transactions. This is not only an important element of our overall strategy, it was critical during this period when in-store shopping was not always possible. In just 45 days, we set the foundation for Michael's next chapter as an omni-channel retailer by rolling out curbside service, expanded ship from store, same-day delivery, Shop My Store, in-app purchasing capabilities, and chatbot, and many other offerings. We are working on a number of additional capabilities that we plan to roll out over the remainder of the year. Looking back on the quarter, the work done here by this team under challenging operating conditions was very impressive. In an unprecedented environment, our teams executed well across each of these focus areas, and our operational performance was solid. The impressive pace at which we were able to advance on our initiatives positions us favorably as we move ahead. And as I look at the list of customer-facing capabilities we introduced during the first quarter and the pipeline of what is to come, I am truly excited with the direction we're headed and confident in the future success of Michael's. Now let's discuss our first quarter results. Sales in the quarter totaled $800 million, down 27%. The year-over-year decline was driven by temporary store closures in the second half of March and April due to the COVID-19 pandemic. Partially offsetting the impact of the store closure was a significant increase in digital sales, which I'll provide some incremental detail on shortly. Where we were able to do so, in compliance with state and local authorities, we kept our stores open, allowing us to preserve jobs and meet strong customer demand for our products. Within the various categories of the store, we saw solid demand within painting and art supplies and other core crafting areas as families sheltered in place and many took on the added responsibility of homeschooling. Our comparable sales for the quarter were down 27.6%. Importantly, though, we have reopened stores in May. Demand has been strong with these stores reporting an average comparable store sales of 11%. We feel really good about these sales trends, but it's early and we acknowledge that craft pantry loading as well as the benefits from stimulus checks may also be contributing to these strong results. So it's something we'll continue to monitor. Now moving to e-commerce. Our digital sales performance was a record for Michael's, growing at nearly 300% in the first quarter. As stores temporarily closed, digital sales accelerated throughout the quarter as we aggressively ramped up our omni-channel capabilities. We don't anticipate this rate of growth to continue. We do expect to see our e-commerce penetration to total sales continue to increase going forward. Consistent with this surge in digital activity from the end of February to the end of April, ComScore ranked Michaels.com among the top 20 of all retail domains. This was our first time appearing in the top 20, and we were pleased to be in the company of some of the largest online retailers. We were even more pleased, though, that Michaels.com was a place that families turn to as they look for creative outlets for themselves and their loved ones during this challenging period. The rapid launch and expansion of key capabilities I discussed earlier enabled us to meet the increased digital demand this quarter. We continue to work on a host of capabilities that will further enhance the digital shopping experience for our customers, and we believe will position Michael's to capture increased share in the future. We are encouraged by the solid demand we're seeing as we continue to open stores. As of today, we have roughly 1,000 stores open and fully operational, and the team is working to increase that number on a daily basis. Costs related to the COVID-19 this quarter totaled approximately $15 million, and were comprised primarily of costs associated with benefits and salaries for furloughed workers, as well as hazard pay for certain team members, as well as the write-off of seasonal inventory that could not be sold due to store closures. Gross margins in the quarter were 27.7 versus 38.2 last year's first quarter. The year-over-year decline was primarily driven by the impact of deleveraging occupancy and distribution-related costs because of the temporary store closures during the period, as well as impact from tariffs and channel mix. We did see some benefit, however, from our ongoing pricing and sourcing initiatives, which provided some partial offset to the pressure experienced from our closures. SG&A as a percent of sales also deleveraged versus last year, but on an absolute dollar basis declined 12% versus the first quarter of last year. And while Michael's has a lean cost structure, this quarter we took aggressive action to further rationalize spending across the company. Moving to our liquidity position. We ended fiscal 2019 with a strong cash position of over $400 million. In March of this year, we proactively drew down $600 million on our revolver, adding to our cash position and further increasing our financial flexibility. As a result of our strong liquidity position at the start of the quarter and the immediate steps we took during the quarter, including drawing down on our revolver, curtailing expenses, and managing cash outflows through strong working capital management, we ended the first quarter with $927 million in cash. After the end of the first quarter, given our outlook, we paid down $300 million on the revolver draw that we did in March. We still have access to this significant borrowing capacity should the need arise. The preservation of our cash and liquidity will remain a priority for us in the quarters ahead as the uncertainty around COVID-19 remains, but we will continue to invest in capabilities that will further solidify and strengthen our competitive position. I believe that COVID-19 has fundamentally changed the retail industry and accelerated shift in shopping behaviors with even a greater focus on e-commerce. While we are committed to reshaping our business through our Maker strategy before COVID-19, we use this time to accelerate key elements of our strategy to quickly adapt and serve the needs of our customers during this tumultuous time. It's impressive what we've been able to accomplish over the past quarter, and particularly the last 45 days. Michael's is well on its way to becoming a leading omni-channel retailer with a robust suite of digital capabilities. Through the hard work of our team and enabled by a solid technology infrastructure foundation, we rolled out several customer-facing initiatives that I mentioned earlier. For example, in mid-March, we tested and launched curbside pickup over the span of just a few days. Customer response to contactless pickup has been very positive, and we expect this to remain a mainstay in customer shopping over the coming quarters as well as the long term. And although a number of stores were closed to foot traffic during the quarter, we utilized over 80% of our stores for ship from store, BOPUS, and curbside, as well as other fulfillment options. In April, we successfully rolled out same-day delivery across 750 of our stores and has since expanded to well over 1,000. And while still early, the customer response to this offering has been extremely positive. We expanded other e-commerce options, including ship from store and BOPUS offerings. We initially utilized 300 stores for ship from store, and by the end of the quarter, we had approximately 1,000 stores. This was an important capability as it enabled us to unlock store inventory to generate sales while safely meeting customer demand. We recently increased the utility of our mobile app, enabling in-app purchases, and while it's still early, we're encouraged by the 3x increase in conversion thus far. In the months ahead, we will continue to introduce new capabilities that will enhance and streamline our customer shopping experience across multiple interfaces. These will include increased personalization on our michaels.com website, improvements to curbside pickup, contactless shopping, as well as the ability to track shipments, initiate returns, and more. It is important to note that our e-commerce business is profitable across all nodes. Combine the quarterly growth along with profitability drives our commitment to build out these enhanced capabilities. Our teams at Technology Infrastructure performed well and effectively met the increased online demand this quarter, which at times was beyond anything we had seen before, including Black Friday. In addition to increasing the number of ways we help our customers shop, we also reshaped our marketing strategy this quarter to align with our enhanced digital and omni-channel focus. Our Made by You campaign is aimed at creating a dialogue with our customers through education and creativity. We are fostering passion in arts and crafts and sharing inspiration with Maker customer base. We believe that the strong engagement and connection with our customers will help drive increased loyalty and, in time, increased transactions. And as part of this effort, we are utilizing digital communication methods to reach our customers. For example, we started a text program, and after just 2 months, we have over 2 million members with whom we have a one-on-one connection. And importantly, we're building these relationships while continuing to provide value to the customers with a combination of great deals and coupons. And finally, with the stores closed during the quarter, we pivoted quickly, providing our customers with thousands of projects and how-to videos. We also hosted virtual classrooms in lieu of store-based classrooms, and the customer response was positive. All these actions underpin the tenets of our Maker strategy. The realities of the current environment have shifted the timing of some of our priorities, but our direction and strategy may remain consistent. Our work to plan and execute category resets, where we bring in fresh and curated SKUs, continues, and we anticipate a lot more newness coming throughout the balance of the year. And after a successful pilot, we now expect to roll out our loyalty program later this year versus our original timeline of April. And finally, on the heels of strong performance from our first Maker prototype store here in Texas, we expect to open a few more prototype stores later this year as well. We definitely seize the opportunity to improve execution and accelerate our digital agenda in the current environment. I am confident that we're striking the right balance between preserving cash and at the same time positioning Michaels to return to sustainable future growth. Before I close, I'd like to provide some additional color around our recently announced decision to close our wholesale operations, as well as provide an update on the business trends we're seeing today. First, following the end of the quarter, we announced our intent to close our Derice wholesale operations. Though we will retain the resourcing-related offices in China, we expect this process to be substantially completed by the end of November. As part of this closure, we anticipate primarily non-cash after-tax charges in the range of $46 to $52 million. Well, we are not in a position to provide a formal financial outlook for the second quarter or for the rest of the year. Let me share a few insights to help you think about our expected performance. As of the last couple of weeks, we now have a majority of our stores open, and as I had mentioned earlier, comps for the stores we reopened in May are on average 11%. We are working to continue to open stores, and based on state and local laws and guidance, we are currently expect to have substantially all our stores open and fully operational by the end of June. Ahead of store openings, we are proactively investing in implementing health protocols and training associates so when we are able to open stores, we are ready to go on day one. Longer term, I am confident in Michael's ability to gain market share in the post-pandemic retail environment. From a cash and liquidity perspective, Michael's is in a strong position due to the work we have done to reduce costs, cut and defer capital spending, and effectively manage our working capital. We expect to utilize cash in the second quarter. Based on our current view, we expect the second half of fiscal 2020 to be cash flow positive, and we believe that we have sufficient liquidity for the foreseeable future to fund planned CapEx, working capital requirements, debt service payments, and anticipated growth. Importantly, I am confident that the actions we have taken and continue to take will strengthen our business over the long term, allowing us to continue to be on the offense and position Michael's to achieve sustainable long-term growth. So in summary, our teams have made great progress pivoting to a digital-led model in a short period of time and under difficult circumstances. We're moving in the right direction with our strategy to better meet our customers where and when they want to shop, and are adding talent to the strong Michael's leadership team to execute on this strategic agenda, as evidenced by the 3 additions to our management team. Tim Cheatham, who joined us from Walmart as our new general counsel. Xiao Wang joins us from Shenzhen SMHQ Technologies and also spent time as CTO at Sam's Club as our new Chief Information Officer. And finally, I'm pleased to welcome Melanie Berman, who was previously at Anthem as our Chief Human Resources Officer. We continue to make good progress in our search for a new Chief Financial Officer as well. As we mentioned on our call last quarter, we continue to look forward to sharing more about our Maker strategy, our new leadership team, our financial algorithm, and our capital allocation model during an upcoming Investor Day. Given the current environment, we have not committed to a date yet, but we'll keep you informed as the decisions are made. With a global health crisis creating what was undoubtedly a challenging quarter, we were able to execute well while safeguarding our team and our customers, which remains our top priority. Our team pushed forward with speed to accelerate Michael's journey to operating as a leading omnichannel retailer with strong digital capabilities. Additionally, we took aggressive steps to preserve financial flexibility and maximize liquidity during this unprecedented time. As we move forward, having all of our stores open again, we are confident in our ability to navigate the current environment and emerge in an even stronger competitive position. My kudos to the team for pushing forward in what was an unprecedented set of operating conditions. And I thank each and every team member for their hard work and contributions. Operator, we will now move to the Q&A portion of the call.
We will now begin the question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. Please limit yourself to 1 question with 1 follow-up question. If you have additional questions, you may re-enter the question queue. At this time, we will pause momentarily to assemble the roster. The first question today comes from Steve Forbes of Guggenheim Securities. Please go ahead.
Good morning. I wanted to start with the second quarter to date comp trends, right, regarding the 11% comp noted for reopened stores. So maybe just a multi-part question on that. I guess, is that an omni-channel comp or store-only comp? Can you help us understand, right, how e-commerce trends have trended, right, as we've entered the May time period? And then just clarify again what subset of stores that 11% comp pertains to. Is it's all 1,000 stores that have been opened by early June?
That's a good question. The total 11% comp is a total comp including stores and e-com, including all the transactions that take place around BOPUS, curbside, delivery, also through our ship to home, but also in our store base. And it's a pretty much a broad-based comp we're seeing across most categories within the store and our e-commerce platform. I would say both have been showing real positive signs as our stores have opened up. Our e-commerce trends continue to improve, as well as the in-store base. So we're very encouraged with the signs we're seeing with the bounce back. And that's a rolling number as you know, we started out in May with some stores open and it's rolled up to roughly 1,000 now. So that's an average of the stores as they roll up, and some have been open for multiple weeks and some have opened for a week or so. But we're encouraged with the overall trends for sure.
Thank you. And then just a quick follow-up, because I don't believe promotional pressures were noted during the first quarter as a gross margin headwind. So maybe just discuss what you're seeing in the competitive environment in general, and then just the frequency and depth of planned promotional, your promotional plans, right, as we look out to the second quarter and beyond.
Yeah, you saw a mix of promotional strategies across from a competitive standpoint. For us, you would have seen the depths of promotion probably not be as deep as the mix and the change in the approach on how we fulfill orders. And you saw a change in our marketing as well. We pivoted really aggressively to being a brand you interact with, how you get content, how you learn in classrooms, how you make masks, how you teach your kids from school at home, and how you do your craft. So we changed our marketing mix, and we changed our depth of promotion during the quarter, and that's what you saw. And you saw a real positive response from our customer base. Is that what was needed as they were going through this kind of tumultuous time at their house?
Thank you.
Thank you.
The next question today comes from Christopher Horvers of J.P. Morgan. Please go ahead.
Thanks. Good morning. So can you talk about your comps for the first quarter, down 28? You out-comp some other retailers not in your space, like a Dick's Sporting Goods and even Ulta. Trying to get the sense of how many stores were actually open, because you were essential and were allowed to be open. So can you give us a sense of how the stores were, the cadence of stores that were open, once COVID hit and shelter-in-place orders went in place, and then did they the number of stores degrade as jurisdictions tightened up, and so just the flow of how many stores were actually open throughout the quarter?
Yeah, it varied as, rolling stay-at-home orders and closures came across the country through mid-March and all the way into April. I would say April was our lowest point, where we had over 900 stores closed and really only 300 stores open. With that being said, we were able to utilize over 80% of our stores with either from ship-from-store capabilities or curbside, which enabled us to keep fulfilling orders and keep driving sales for the customer demand we were seeing, and also helped alleviate some of the inventory that was basically trapped in stores and freed up a lot of our ship-to-home capabilities from our FC. So overall, we hit a low point of 900 stores closed, but we're able to generate sales and commerce through about 80% of our fleet at the time, really due to the fact that our team really aggressively rolled out, ship-from-store, same-day delivery app. So I was really pleased with the way how quick we pivoted to a digital omni-channel retailer, and we're able to use some of our store base to deliver on that demand.
Understood. So two follow-ups. So one, how is your inventory position now? I mean, it sounds like strong comps in May. Do you feel like you're clean? It also sounds like you were less promotional. So that would suggest you're sort of clean going forward. And then can you also give us an update on AC Moore and the inventory liquidation, and whether or not you felt like that was an additive to comp at any point, including the month of May?
We feel really good about our inventory position. Really, like I said, we were able to use trapped inventory from our ship-from-store fulfillment strategy, and on top of it, the strong demand we're seeing as stores open. So we actually feel really good about where inventory is. Our in-stock levels seem to be strong, and we seem to be really good from a supply chain standpoint. Most and all of our DCs remain fully operational almost the whole time. So we feel really good about our inventory position, and haven't seen really any supply chain disruptions coming out of China or any other places. So we feel good about our inventory position. As it relates to AC Moore, we were trending quite well on the transfer going into February and into February as well. And as you know, most of those stores are located in the Northeast, where a lot of the store closures are and actually still remain. But we were pleased with the transfer, and we still remain confident in the opportunity to capture significant sales transfer as they open up. But on the 19 stores we're taking the leases on, and 3 were Michael's relocation, that we originally planned to do that in the second quarter. Most of those now are being pushed out to fiscal 21. on the MIK on the AC Moore piece.
Meaning that you won't necessarily open those stores, but AC Moore is still going away. So the comp opportunity as in the back half is still there, and for the rest of the AC Moore stores that you're not assuming the lease, are they all gone at this point?
Yeah, those are all gone. And like you said, we were trending really well in February and above our forecast on the transfer. So we remain confident that when the stores reopen, and as they have reopened, we're seeing that sales and share transfer to us.
Understood. Best of luck. Thank you.
Thank you.
The next question comes from Simeon Gutman of Morgan Stanley. Please go ahead.
Hey, good morning. It's Simeon. Hope all is good. My first question, Ashley, I don't know how much you can track market share. Right, your category should be or probably was a stay-at-home beneficiary, and I'm sure some parts of your store were not. Curious what you think share or how share trended in the quarter, and whether or not having stores closed eventually hurts you from a market share perspective, maybe later in the quarter.
It's a good question. As you know, it's a hard category to track share. And with that being said, from our pure play arts and crafts competitive set, we're on almost an equal playing field. I think some were allowed to stay open more than us. But with that being said, I think our digital capabilities that are rolled out offset a lot of that. And it's a SKU intensive category. So when you look at a mass perspective, it can't offer the full breadth of what we're offering. So it's really hard to determine the share piece. But with that being said, I think from what I've seen with the digital capabilities that we rolled out, with the newness that's come in, and the early results of that new product with the way the customers are interacting with the new ways of shopping, I'm very confident in our ability to maintain and grow share in this category. And you're seeing it, I think, in what we're seeing in the May openings as we moved on. As our e-com has remained the positive growth it was throughout the quarter, plus the store base recovering, and you're seeing those people and new customers shopping the way that they haven't been able to shop at Michael's before has been very, very encouraging.
Got it. My follow-up is two parts, but it's related to the same topic. It's omni-channel platform. Curious, I'm sure you have goals of what you wanted this platform to look like from a capability perspective. Curious, what percentage of the way are you there now, given some of the quick moves you made in the quarter? And then how inefficient were you? If you're just doing ship from store now, how much more efficient can you get? In other words, I'm sure gross margin was impacted by this big shift, but I'm guessing you're not doing it optimally yet. And so, I guess it's all tied to what the margin structure could look like when you get this thing operating more optimally.
I think, like I said last quarter, when it talks about how big e-com can be, we don't put a number on it, and we don't put a number on it for really the specific reason of I want the customer to be able to interact with us and shop with us however they want to. Whether that's, buy online and pick up in store, go inside the store, do the curbside, have it delivered to their house on the same day. We just want them to interact with our brand however they want to react with it. And, I think what you're going to see is a subset of customers take advantage of each one of these capabilities differently. And I think from that, it'll be an easier way for them to shop and have more interaction with our brand on a weekly and monthly basis. And as far as it comes to mix, we have invested over the years on getting our costs down, but we still have a long way to go. I'd say, we're constantly thinking about how to reduce costs and make all nodes profitable. And e-commerce is profitable across all nodes, which is a real positive. So that way you can actually really invest and lean in. And we have a host of capabilities that we've mapped out throughout the rest of the year, this quarter, the third quarter, and the fourth quarter that we intend to roll out very, very quickly. And like I said, we did a lot of these capabilities in 45 days. And the agility and nimbleness of that team to do this in a really short time frame, and the roadmap we have going forward is very encouraging on the way the customers are going to interact with us in the future.
Thanks, Ashley.
Thank you.
Again, if you have a question, please press star, then 1. The next question comes from Kate McShane of Goldman Sachs. Please go ahead.
Good morning. Thanks for taking my question. I just wanted to ask about marketing, if there was a pullback in that spend during the first quarter and how quickly you plan to ramp that back up and in what forms.
Well, like I said, we had a plan to, over time, change the way we interacted, I think, with our customers from a brand perspective. And I think what this allowed us to do is people sheltered at home and were looking for ways to either be creative, to create arts and crafts, to spend time with their kids, or even to make money as they made things and resold them. We took that opportunity to rapidly change the way we did our marketing. And that marketing was deliberate. It was a pre-planned rollout. We just were able to roll it out more quickly based on the customer demand. And what we saw was a significant positive interaction with the customers. They saw us as a way to educate, a way to inspire, a way to create, and a way to spend their time. And that was a change. And I'm not saying we're walking away from promotions and coupons, because we were still there as well. It's just a balance of what we've seen. And we still continue to bring value through everyday pricing and our promotional strategy. But we'll be nimble in how quickly we go back to the level and depth of promotions we had previously based on demand. But we really encourage the way they're interacting with our brand right now.
Thank you.
The next question comes from Elizabeth Suzuki of Bank of America. Please go ahead.
Great, thank you. I had a question on the wind down of Doris. So, back when it was acquired, the management team had expressed that Michaels was already moving from branded product into more private label, and that there'd be incremental margin benefit from moving from third-party private label to direct sourcing. You eliminate some of the fees, you get greater control of the product. So what's changed since then that, such that Doris is no longer viewed as a beneficial asset to Michaels?
Well, I think that if I parse that question out a little bit, going private brand is still a strategic imperative and initiative for us. And what you're seeing is we'll see an increase in private brand penetration, we believe, over time. And I don't believe that the closure of Doris will impede that at all. We took a strategic view of it, and in the long-term plans, we decided to close the wholesale business. And over the years, they had lost some large clients. And we reviewed the go forward, and we saw really no viable path to profitability long-term on that. It did have some positive assets, so we're going to keep. We're going to keep the sourcing office. It had some accounts receivable systems that we'll be using going forward, and some warehousing capabilities. But we didn't see a long-term viability to growth or profitability, and we didn't see how it fit in our long-term strategic approach.
Okay, and then just since Doris was the last of the Lambright West assets to be wound down, after Pat Catan's stores were closed, how are you thinking about potential for M&A or partnerships from here? And does that experience change your view on future transactions?
In our current view, we don't expect M&A to be a major priority for us at Michaels, but we will be opportunistic should that opportunity arise, for sure.
Okay, great. Thank you.
The next question comes from Carla Casella of JP Morgan. Please go ahead.
Hi, I have one follow-up on Doris and then a couple others. But on the Doris business, does this affect the expectations you had for tariffs this year, and also of the costs expected to be incurred for the Doris exit, how much of those are cash versus non-cash, and the timing?
Yes, there is no impact to our costs related to tariffs as a result of this wind down. So that still is expected to be approximately $45 million of incremental tariff cost in 2020 as compared to 2019. And then the second part of your question was related to
It was the cost of Doris, how much of it's cash versus non-cash and the timing of it.
Yeah, so the majority of it is non-cash, and the timing will be spread throughout the quarters, but all within 2020. We will see some cash benefit in 2021 specific to taxes.
Okay, great. And then one business question. Can you give us a sense for the e-commerce performance by month, March, April, May?
Yeah, we're not breaking it out by month, but what you saw was a considerable increase month to month as the stores closed, and as we rolled out mainly our capabilities. Each capability we rolled out seemed to accelerate the growth in our e-commerce business, which is maintained even into the current quarter.
Okay, great. Thanks.
Thank you.
The next question comes from Laura Champagne of Loop Capital. Please go ahead.
Thanks for taking my question. So the 11% comp out of the gate is awesome. I would like you to comment on sort of what the puts and takes are for how sustainable that would be. Do you think that there's clearance of your own product driving this? I mean, do you think that we come out of this with positive comp in the back half, or does that possibility look remote to you?
I mean, how sustainable it is unknown. If it's some craft pantry loading, clearly some benefits from the stimulus checks, and so just some basic pent-up demand, I believe. We're monitoring it, on a daily basis, but we're not providing any back half guidance on how we think it's going to continue or not continue. But we are encouraged with the reopening start for sure.
Great. And when you plan inventories for the back half, what's your philosophy in your initial orders for seasonal this fall and holiday?
Our hypothesis from the beginning as we went into this in February, because we were really proactively, we saw what was coming early, and so we preserved liquidity early. And then once that happened, we realized that our anticipation was what the demand might look like in the back half. So we rolled out a lot of strong capabilities in preparation for that, from a digital perspective, and then from an inventory ordering perspective. We thought we had gone through the trough of it in Q1, so we remained positive on what the back half and particularly seasonal would look like. It's a slight decrease in seasonal orders, but not to the degree that probably most would expect.
Got it. Thank you.
Mm-hmm.
The next question comes from Cristina Fernandez of Telsey Advisory Group. Please go ahead.
Hi, good morning. Will you be able to comment on the performance of the stores that remain open during the first quarter? How did those do relative to what you're seeing in May?
Yeah, we're not breaking out how the stores that remain, the 300 stores that remained open out the whole time versus the entire fleet. I mean, obviously they did better than the entire fleet when you're closed, but we're not breaking those numbers out. We're also seeing a similar trend across with the stores that remained open and the stores that reopened in May.
Okay, that's helpful. And then could you expand on the category trends that you've seen and have evolved through the quarter and to May, last quarter, or when you reported last time, you commented that seasonal home decor were softer and arts and craft were weaker. I think you mentioned today that most categories are positive and you're seeing broad-based strength, but any more color there by category would be helpful. Thanks.
Yeah, it reinforced our maker strategy throughout the quarter. What you saw was strong demand in core making categories, canvas, paint, kids crafts, all the things that we've discussed is around our core maker. And as the stores are closed, we saw a demand contraction in seasonal demand and home decor, and that trend continued throughout the first quarter. And then as stores stores reopened, you saw kind of a broader base demand where core crafting still remains strong, and then an uptick in our seasonal business as well.
The next question comes from Zach Fadem of Wells Fargo. Please go ahead.
Hey, good morning. Looks like you were able to take out about $35 million of SG&A versus last year, excluding some of the adjustments. Curious if you could walk through the details. How much was labor? Was there any that was previously categorized as a fixed cost? And how should we think about that trajectory with stores reopening in Q2?
Yeah, we've definitely taken out some costs, as Ashley has mentioned earlier. Due to the store closures, we had a fairly significant number of team members furloughed, which had somewhere in the neighborhood of $20+ million positive impact. We right-sized our marketing costs and made some shifts in where we focused on marketing as well. But overall, there was a slight decline in marketing costs. We did incur some additional costs and SG&A related to COVID-related items, and a lot of that had to do with hazard pay and certain sanitation supplies that we bought. So there's a lot of anomalies going back and forth, and as we reopen stores and bring furloughed people back, and some of these sanitation costs start to subside and hazard pay starts to get pulled back, we'll see a more normalized SG&A run rate.
So sorry, go ahead.
Oh, sorry, yeah. I'll just add on that. And then we've done, obviously, an end-to-end assessment of our entire cost structure. And we still see opportunities to run more efficient operation and a leaner cost structure going forward. And we're looking at those assessments as well. And we anticipate to have some investments in our capabilities, and those timings might not line up exactly, but we definitely see an opportunity to operate on a leaner cost structure.
And I'll remind you as well, at SG&A, we're going to be comping a pretty low performance-based compensation from last year. So you will see that headwind as we go forward in the year.
Got it. That's helpful. And then just wanted to follow up on the $15 million of COVID costs that you called out specifically, and which you would categorize as recurring versus non-recurring in Q2.
Yeah, again, a lot of that had to do with hazard pay, both for our DC and our store employees. So certainly a significant chunk of that was in SG&A, and a lot of that would be pulled back. There was a huge push for sanitation costs. Certain amounts of those, for example, in the stores, setting up plexiglass barriers for our cashiers and getting hand sanitizer placed throughout the store. Some of those costs will even out, but there'll probably be some small incremental costs as we go forward as we maintain it.
And the great thing about the plexiglass cost is, we made it in-house in our artistry factory. So the cost to make that was actually probably significantly less than if we had to procure it on the open market. And it opened up an interesting assessment of our artistry business because of the things that we can make outside of just custom framing.
The last thing I would add on the COVID-related cost is we did have the seasonal inventory write-off in Q1 related to inventory that we needed to get out of our stores and were not able to due to their closure. We will experience some of that in Q2 as well because of the stores just now opening up in Q2, and obviously we will have to get the stores cleared out and ready for our back half seasonal merchandise. So we do expect to experience some incremental potential seasonal inventory write-offs in Q2.
Yeah.
How much of the 1,000 basis points was the write-off?
The basis points, we don't have it right on hand, but certainly we it was quite the absolute dollar amounts were quite a bit higher than last year, given how many stores were closed and the seasonal product that we had in the stores that wasn't able to sell through as quickly as we normally would have. So yeah, and to Jennifer's point, we did take some additional charge because of that, and that's obviously included in gross margin.
All really helpful. Appreciate the time.
This concludes our question and answer session. The conference has now also concluded. Thank you for attending today's presentation. You may now disconnect.